On the surface, Costco looks like a retailer that forgot to charge enough. Issaquah, Washington. Jim Sinegal built a giant company on merchandise margins most merchants would reject in the first meeting. The surprise sits elsewhere. Costco makes its real money by getting paid for access. Sinegal was a merchant's merchant. Saul Price trained him at FedMart and Price Club before Costco opened in Seattle in 1983. Jeff Brotman, the co-founder and longtime chairman, understood capital structure and temperament. Charlie Munger later joined the board and recognized the model instantly. The room was unusually disciplined. The supporting cast mattered. Richard Galanti, chief financial officer since the mid-1980s, became the calm voice on earnings calls and in annual reports. Craig Jelinek, Sinegal's operating successor, kept the culture narrow and hard. Few retailers survived founder transition. Costco did, because management treated the formula like board minutes. The setup began with a very old retail problem. Traditional supermarkets and department stores tried to make money on each item and then advertised around the damage. Costco reversed the sequence. It created traffic first, accepted skinny gross margin second, and collected a predictable fee stream before the first rotisserie chicken left the building. That only worked because the warehouse was stripped to the studs. Limited stock keeping units, pallet display, sparse decor, low shrink, rapid turnover. A conventional grocer might carry 40,000 items. Costco often sits near 4,000. The labor model is simple. The inventory move is the show. Friction is the enemy. A prior move mattered too. Costco merged with Price Club, combining two operators that already understood warehouse economics. The deal created scale in procurement and credibility with suppliers. Buyers could promise volume and mean it. The pattern is older than the press. Purchasing power starts before the customer arrives. Now, to the mechanics. Costco's annual report states plainly that net sales dominate revenue, but membership fees are the cleaner profit stream. Revenue reached roughly $254 billion. Membership fees were about $4.8 billion. Net income was about $7.4 billion. That math tells the board almost everything. Merchandise economics are intentionally austere. Costco has long said it caps markup on branded goods around 14% and private label around 15%, with some exceptions. Many retailers would call that a planning error. Costco calls it policy. The price is the easy number. The price is never the deal. The actual deal is trust. A household pays an annual fee, enters the warehouse expecting honest pricing, and buys in bulk because comparison shopping becomes unnecessary. Renewal rates then do the heavy lifting. In recent filings, US and Canada renewal rates sat around 92%, with worldwide rates near 90%. That creates operating leverage of an unusually civil sort. Membership income arrives upfront. Inventory often turns quickly. Suppliers fund part of the working capital through payables. Customers, in effect, prepay for permission to buy. A great many retailers spend fortunes chasing loyalty. Costco invoices it once a year and keeps the receipt. The friction has always been cultural. A merchant seeing queues at the door is tempted to widen assortment, lift prices a touch, and harvest margin. That is where the board needs a hard head. Sinegal resisted that drift repeatedly. He cared about a hot dog combo staying cheap with a stubbornness directors usually reserve for poison pills. There is also labor. Costco pays better than many rivals and offers benefits the discount sector often trims first. On a narrow spreadsheet, that looks generous. In a board packet, it reads as throughput insurance. Lower turnover means cleaner execution, better in-stock conditions, and fewer hidden costs buried in training and shrink. E-commerce introduced another stress point. The warehouse treasure hunt model was built for physical traffic, while online retail trained customers to expect infinite assortment and doorstep delivery. Costco adapted carefully. It used digital channels where they fit, kept the assortment tighter than peers, and avoided turning itself into a low-return parcel network. The result has been unusually steady. When discretionary retail softens, members still visit for staples, fuel, pharmacy, and food court habits. Traffic remains resilient because the membership reframes the trip. Shoppers feel obliged to use what they paid for. That small psychological lever has protected many quarters that might otherwise have looked ordinary. Wall Street has often granted Costco a premium multiple that appears excessive beside its operating margin. That can look absurd. A company selling near cost should not trade like a luxury asset. Yet the market eventually recognized the fee stream, renewal engine, and working capital efficiency hiding beneath the cereal boxes. The first earnings call after any membership fee increase usually sounds familiar. There is ritual hand-wringing about churn, pushback, and consumer fatigue. Then the numbers arrive with their usual calm. Renewal stays high, traffic holds, average ticket behaves. The room knew. The customer had already accepted the contract years earlier. I have seen cousins of this model before. American Express built a card business around trust, merchant acceptance, and annual fees that bought status and utility at once. The product looked transactional. The economics sat in the relationship. Once the habit formed, price competition on each swipe mattered less than membership in the club. Another analog was Amazon Prime in its earlier years. The fee seemed modest. Shipping economics looked messy. Critics focused on item-level profitability. Management focused on frequency and lock-in. Pay once, return often. Different category. Same boardroom logic. A recurring access charge can reorganize customer behavior more effectively than 1,000 promotions. What 30 years in the room taught me is simple. The finest businesses often hide the toll booth behind a popular service. Investors stare at the visible unit economics and miss the contract. Costco sells detergent, beef, and televisions. The stronger asset is a paid habit, renewed annually, enforced by trust and repetition. I have seen this before. Here's what it means. Costco is a subscription business wearing a retailer's name tag, and those models endure until management tampers with trust for a few extra basis points. Who's running this same playbook today? Comment one name.